Everyone is asking the same question about should I buy in Dubai or Bali?
We are going to discuss about to compare the real estate in Bali and real estate in Dubai. They are both amazing, spoiler, amazing investments.
But after looking at dozens of deals, I don't think that's a real problem here because most people aren't even evaluating the things that actually making sense and drives the outcome. Let me show you what I mean. So a typical Bali project might tell you 14% of annual return, 70% of occupancy, and $250 per night. Sounds reasonable. Let's just run the math. So $250 per night multiple 270 nights, which means $67,500 a year. And if the price of the property is $450,000, that's roughly a 15% gross yield. So far, everything checks out. But this is where most people stop. Now let's look at what's not in that number. Management fee, 20%. Platform fees, anywhere from 3% to 15%. Maintenance, staffing, utilities, vacancy fluctuations, taxes, owner usage, future refurbishment. Once you factor all of those in, that 15% doesn't stay 15%. It's usually around 8 to 10%. And here is the most important part. The developer didn't lie. They just show you the version of the model that works the best. So the real question isn't, is Dubai better than Bali? It's who built this model and what assumptions are they making? Because at that point, you are not choosing a market, you are choosing a developer. And this is where things get more subtle. Let's say a developer tells you they've done multiple projects before and that sounds like experience. But what kind of projects? If they've built low-density villas before and now they are selling a high-end hotel-style investment product, and that's not the same capability. Building something is one skill, operating it profitably is another, and delivering constant returns to investors is something else entirely. Now let's talk about off-plan. The risk isn't it's not built yet. The risk is you are paying today for something that will only be proven in the future. So I always look at payment structure. For example, 30% upfront, 40% before construction really in progress, 20% of mid-stage, 10% on completion. That sounds reasonable and normal. But if 70% of your capital is already out before the asset is meaningfully built, you are financing the project, not just investing in it. So a simple way to think about it, the speed of your money goes out should match the speed of the asset actually forms. If those two things are misaligned, you are carrying risk. And then there is legal layer, things like land status, building permits, operating license. Most people don't know how to verify this because they are not even in the sales material. But those things are actually the things define whether the asset even exists in a valid structure. And if something is wrong here, you can't even fix it later. So what you are really doing when you compare projects is making a decision based on a filtered version of reality, not raw data. And that's just how these markets work. Which means the real problem isn't which country should I choose, it's do you actually have enough signal to make these decisions at all? And if you are already looking at something but there are few things don't add up, pause there. Usually it only takes 1 or 2 points to know whether a deal is worth doing deeper. Don't say something is risky, just see how numbers break.